Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup. This is for the trading week ending April 30th, 2021. We're rounding out the end of the month and starting a brand new month. I'm Preston Brent. Thanks for tuning in. This week's theme is a peak in the market price action near? We're going to see pretty soon. Why don't we take a look at where we were this past week, and then we'll just kind of go forward from there. So what I want to do is just kind of break this out, and we'll take a look at the index performance first. You can see here that for the week, it was fairly mixed to flat for the U.S. markets this week. Dow and Nasdaq underwater just slightly. S&P and Russell just slightly above water, but essentially flat for the week. Year to date, everybody's doing really well. Russell's leading the way, followed by the S&P, the Dow, and the Nasdaq bringing up the rear. You can see the PE ratios. The trailing is 39.76, which is coming down off the highs, but still very high. But the forward PE is the one we're more concerned with. It's at 23.07. That's a pretty good PE ratio. It's very high. Dividend yield for the S&P closed out Friday at 1.37%. 10-year Treasuries at 1.63. So we still have a spread of 26 basis points, meaning the 10-year Treasury offers that much more percentage-wise, almost a quarter of a percent higher than the S&P. And the wider that gets, the more money is going to want to pull out of equities and get into the 10-year. The current VIX, it was up this past week, 7.4%. It closed at 18.61. And then if we look at the sector performance, energy did the best, a little over 3.8, 3.9%. Technology brought up the rear at 2.13, which is really not a good thing considering the earnings that came out with Amazon, Facebook, Microsoft, Google. Very strong earnings, but yet if we look at the charts, and I'll show you in a minute, they all pull back a little bit. Strong earnings, strong performance. Microsoft, every one of them is beating on the top line, bottom line, very strong, very handily. And we would expect a lot better performance, but this tells me price action is a little bit tired. Annual sector performance, energy still leading the pack at 20.38%. Staples bringing up the rear, but still positive at 7.6%. Okay. And of course, if we look at this and we look at the economic data for the week and for the earnings, we've had about 180 companies report earnings. Members this Sunday evening, we'll go in a little bit more detail on the earnings. But basically, overall earnings for the S&P have increased year over year 30%. Huge numbers. It's the fastest rate of growth in over a decade, right? And all the estimates, while they were high, were so far coming in even higher than the estimates, okay? Primarily because of these high percentage of earning beats. It's just really, really amazing. The other thing on this is that we got the GDP this past week, came in at an annualized rate of 6.4% for Q1. A lot of it supported by a pretty heavy dose of government spending. Most analysts, I should remind you guys, expect growth in Q2 to be double digits. Okay. A lot of consumer services are doing very well. Consumers are spending more. We got a lot of investment growth. Again, more direct government spending with this American Rescue Act. So that does help grow the GDP numbers. Also, we're seeing weekly jobless claims that fell below its pandemic era low, came in strong. The confidence board conference board for consumer confidence hit its highest level since February 2020. That was right before the crash at 121.7. Manufacturing also remains strong. Core capital goods came in at 90 basis points to the upside in March, and that was reversing an 80 basis point drop in February, right? So, and we also got the Fed policy statement. No changes. They still got a very dovish tone. Interest rates are unchanged. Markets didn't react too much to that, okay? And then, of course, if we come over and look at treasuries, treasury markets with the Feds coming out, markets didn't really go anywhere. Fed bond markets, interest rates are kind of creeping up just a little bit, but not that much. The Feds believe that the inflation data that we're seeing is transitory. Now, I would agree with the Feds near term. Right? What they basically mean is because it is a demand issue, Demand is outstripping supply because all the manufacturing companies and shops are just trying to get back open again, and they're trying to get all their parts and components. We got shortages everywhere. Everything from chips, microchips, processors to lumber in the housing building sector. Just huge shortages. All right. We haven't run out of trees or chips. It's just getting everything back turned on again. Once everything comes back in, we'll see prices kind of steady a little bit. We'll see inflation back off a little. Longer term, I believe inflation is going to really take off, but not this year. Okay. Now, if we come over and we look at Europe, and let's just take a look at the indexes for the rest of the planet, including Europe, you'll see here that kind of a mixed bag. The Euro stocks, the 50 largest companies, they were down 96 basis points. Still up. Everybody's in the green year to date across Europe, from the FTSE, the CAC 40, and the DAX. The DAX was down just a little bit, but kind of a mixed bag like the US this week. Now, over in the Asian markets, we did see Nikkei down, China down, Hang Seng down, all for the week. China is also in the red year to date. Okay. Everybody else is in the green. So we're getting some of that data out there. Of course, in Europe, they've had problems with the COVID. They're still having some issues with shutdowns and things like that. And the other thing I'll point out, that the Eurozone economy may have entered into a recession again. Remember, two back-to-back quarters of GDP numbers below zero indicates a recession. So Q4 of last year, they were below zero. And the preliminary estimate for Q1 GDP for Europe shows that it contracted by 70 basis points. That would put Europe in a double dip recession. Right? We are getting some good news that Germany's economy, even though it contracted 1.7%, a lot of the main driver of all this contraction is they're really shutting down pretty hard over in Europe. And that's hurting their economic recovery. I don't think personally they need to shut down like this, but they're going batshit crazy, pretty much like some of the politicians here in the US. But that's what's going on. That's what's kind of slowed them down. But I do believe they're going to start to pick up, and we're going to see the euro as being a great buy and the dollar a great sell. But not right now. Okay, the dollar is kind of fooling people. And then, of course, if we look at China, just kind of see where China's playing itself out. They also, as you can see above, they had a loss for the week and year to date. They also are seeing a weaker than expected the PMI data, the Purchasing Managers Index, coming in as well. So China, being the second largest economy on the planet right now, is having some issues. Now, they've pretty much conquered their COVID crisis, but one of the primary reasons China is having an issue is that their government, because they don't get reelected every 4 years or whatever the number is, they're there for life. They're taking hard measures right now to get their debt under control. They're cutting some of their stimulus so that the market price action obviously doesn't like that. And they're coming down harder on tech companies. We saw that with when Ant Financial tried to go public, and they pretty much stopped them in its tracks. They're going after some of these big tech companies there because they're getting too big. China wants to control everything, so they don't want anything to get too big, especially in the social media space. So they're controlling it. They're putting a halt to it. So that's also hurting the markets. And what I'm going to do is I'm going to take you over and just show you the tracking ETF for China, and then we're going to take a look at some other stuff. So let me just switch the screen here real quick. Let's take you over there. So what we're going to look at is the tracking stock for China. You're going to see that this is Asher. It's a good tracking for the Chinese markets. And in tracking this, you can see here that it actually almost went into bear market territory at the low. In fact, if I were to move it down just a little bit, right down here, and let me just switch it down, it probably came down and just almost into a bear market at 19.3. Amazing. Now notice it's trying to climb back up into the green as I showed you on the previous chart, but just barely, right? We're just barely underwater right now. But all of this is due to taking money out of their economy. All right, things are slowing down a little bit. Price action does not like it when the central bank, or in this case, the People's Bank of China, has nothing to do with the people, but they call it that to make people feel good. You'll see that in communist and socialist countries. They call everything the people's this, the people's that. People have nothing to do with it. But in any event, we can see that they're basically barely in the red, but still in the red year to date, right? And you would think they're doing very strong, but they're not because they're taking money out of the stimulus out of the economy. Of course, if we look at the E-minis, let's look at the E-mini S&P 500 futures. You can see here, huge move up. We had all-time highs on Thursday, and then Friday we just backed off just a little bit. 42.11. If you guys remember, I've been saying my target was between 41 and 43 for the year as far as a high. I wasn't expecting this soon, but we're getting it. All right, and it's just where I see market price action going. I also see markets getting ready to pull back. I can just see price action and the way it's reacting to some of these earnings. A really solid pullback point. You can see these areas of congruency here. We've got the closing price of last year at 37.4875. We got a fib node sitting right around 37.35. And then we got a natural support point at 37.20. So there's a lot of support down in this area. Obviously, before we get there, we'd have to move through the 50 EMA sitting at a little over 4,020, about 4,025 roughly. But if we get the momentum going, I could see us pull down here very easily. What kind of pullback would that be? It would be about, not too far, about 11%. And we'd still be in a solid bull market, roughly, right? So I was calling for anywhere from about a 7 or 8 to 15% pullback. So let's call it 10%, just kind of split the difference. And then we're going to make another run up here. And then that second run, I'm not sure if we're going to be able to surpass the all-time highs or not. If we don't, that means that sets us up for kind of an ugly summer period. That's what I'm looking for. Near term, we could pull back just a little bit, make another run, and continue to make another all-time high. But I do believe sometime in the summer months, without earnings coming out, there's not a catalyst to move us higher. It's going to be ugly. Ugly to the tune of a correction. We haven't had a correction in a while, so a correction, if you guys know, is a pullback more than 10%. So I can see that happening. If we look at the Dow Transports, look at the Dow Transports, guys, and it would only be in correction mode only. It would be worth buying the dip. If you look at it, we made all-time highs on Thursday. So you've got the Dow Transports making all-time highs on Thursday, April 29th. And then if we look at the Dow Futures, they made all-time highs on April the 16th. The Dow Futures tends to follow transports. In other words, transports tend to lead. So we just made new highs in transports. So when we got all-time highs in transports, all-time highs in the Dow theory says we're still in a bullish market. And any pullback right now, you want to be a buyer. I do believe that's not going to stop us from having a pullback. It's merely profit taking after we get through the bulk of earnings. We got another strong week coming up, maybe one more, and then it's going to die down very quickly. And then we're going to get into, maybe a peak in the market. And then going into June, July, August timeframe, the 90-day period, we're going to have this could be one of those years where sell in May, go away made sense. Last year it did not. If you guys remember, the COVID hit in March. We hit a low in March 23rd. And then I got a list of 10 assets that you guys should buy, our members, at least I put it out to our members. Every single one of them was a home run, every single one, because we were buying heavy by the second week of April. And we just stayed long. Some of them in the commodity market did very well. Some of them were still playing. So I think we do need a little bit of a profit-taking pullback. We're going to stay in a bullish mode for now, but I can just see that coming up. Members, I'll go through the breadth charts with you and take a look at beneath the surface. A price action just so that you guys get an idea of what's going on. Okay. Bitcoin, they're going to be coming out with micros in the Bitcoin futures and Thinkorswim shortly. It pulled back. I was expecting a pullback to about 50,000. Notice the fib node at 51,900. I said we should pull back just slightly around that, and we pulled below it. We actually moved down to 47,395. Buyers stepped in. I think it'll move higher near term. We're still beneath the zero line in the MACD, but there is more. There's energy in this thing right now, so I think it'll move up. The key level is 57,750. If it breaks that, that was where we gapped down in a prior session. And then if we look at the prior one right there, 60,100. So we could be stuck for a little bit of sideways action. It could be a bull trap and we roll back over and make new lows. We got another support level at 43,478. We'll track this and see where it goes. It's really hard with Bitcoin, but that's kind of what we're looking at right now. Okay, pretty hard to tell. If we look at the FANG index, you can see here with this index is composed of Microsoft, Facebook, Apple, Netflix, Google, and Amazon. I've thrown Netflix in, but look at it. We made all-time highs on Thursday, and then Friday we moved a lot lower, right? If we look at this and we look at that candle, that's an ugly-looking candle, right? That suggests that we could come back down around this 21,008. Now, this is just an index, so the number is irrelevant to an individual stock price, but it's composed of all of these stocks. Now, if we look at Microsoft blew out earnings, top and bottom line. And you can see here on this earnings, it's gapped down, and it's got a gap here like that it's going to try and fill between 256 and 261. 50 EMA is sitting at 246. It could have a bull trap and roll back over again. You can see the longer term trend line. So we're still bullish Microsoft. I like the stock, but it's just pulling back. So this just says that these FANGs, which represent over 24% of the cap weighting of the S&P, when they pull back, the rest of the markets have no choice generally but to pull back. We were pulling back earlier on FANGs. They were underperforming, and other stocks were holding up the market. But we're starting to see some profit taken in these other stocks as well. If we look at the NASDAQ 100 futures, you can see the same thing, right? We had all-time highs on Thursday, and then it pulled back just a little bit here like this. So we can just see how this thing is going to play itself out. And then, of course, if we come down here and we look at volatility and we look at the VIX, you can see on the VIX, it has just been holding steady here, up and down, going all the way back to the 19th of April. 2 weeks, the VIX has been running sideways, but elevated. Okay, it did get down here to 1538, just north of the very bottom end of my yellow zone. Now we're back up here. I would not be surprised to see it move up. So what we'll probably do, folks, is look at some bullish plays in volatility this Sunday night for our weekly market watch for our members. If you're not a member, I highly encourage you to come in. We're having a great time. Last year we did extremely well with COVID. This year we're off to a very strong start again. So this is kind of what I'm looking at on volatility. And of course, if we look at US Treasuries, right here with the bond market, it's just running sideways to slightly down. Every time the bond market hits the 50 EMA, it rolls over, right? Just a little bit, doing the same thing here. I expected it to break it. I think it still may, right? Which would send interest rates lower. But to get interest rates lower and bonds higher, we need to see a little bit of a downside in the market. So if we get that pullback that I'm expecting over the next 90 days, of anywhere from 10 to 15%, we'll just call it 10% for now, or correction, then I believe bonds will move higher, and then I'll be stepping up to the bellying up to the bar, I guess, and ready to short bonds. But right now, it's just a no trade. Okay. If we look at the 10-year interest rate, you can see here it's backed off from the highs, but I've got a target of the 10-year interest rate around 1.86, 1.9. It's kind of where we're moving to. We've got a high this year of 1.765 for the 10-year. The 10-year is the world's interest-free investment vehicle, right? And every investment is benchmarked off the 10-year, right? And how much better or worse you do, because this is considered risk-free. Of course, we know nothing is risk-free, but it's backed by the U.S. government. And for now, the U.S. government is paying its bills, even if he has to print more money to do it. But it's recognized worldwide as a risk-free investment. So everything is benchmarked against this. Right now, it closed the week at 1.63. Right? So we're going to see where this goes. I do believe it's going to creep higher. And then if we get that pullback that I'm expecting this summer, I think we're going to come back down again. But then it's going to set the stage for a long run higher going into Q3, Q4 of next year, especially Q4. Okay. If we come down and look at currencies, the dollar's fooling everybody. It had a very strong move higher on Friday. Very strong. Everybody was short the dollar over here. And if we just back it out, you can just see the dollar has just been nothing but going down. Over in this area here, I was having our members sell the dollar and buy the euro or just go long the euro. You can just see every time it got over the 50 EMA, you wanted to sell it, much like bonds. It's been a great trade. And then once we got, my target was right here. And I've left it on the screen. It's around 91. Once we blew through the target, I said, do not chase it lower. And sure enough, more and more shorts were, it was a very heavy, crowded trade. Okay. Same thing with the euro, only the euro is crowded to the upside. And then as the dollar started moving higher, the euro, or actually the euro drives the dollar index, not the other way around. But then you can see the dollar pulling back. Now it's going to make another little run up. I think it could be a bull trap, to be honest with you. If we look at the Elliott wave count here on this daily chart, it's showing a 3-leg down. That means it'll put a 4-leg somewhere up in this area here, and then it'll roll back over again. So I would wait for a short opportunity in the dollar, or if we look at the euro, a long opportunity in the euro, right? You can see this nice move up. We'll probably come down, test the 50 EMA. We may even break down a little bit lower, but longer term, I'm bullish the euro. Okay. And for metals right now, gold, it's a no man's trade. We're just running sideways, much like silver. Longer term, I am bullish gold and silver. Short term, no. It's just a dead man trade right now. Copper, we're long term bullish copper, big time. We got long copper, and I think this is one of the free trades I provided to a lot of you guys. I said right here, there were 10 other trades I had, but this is just one of them. And we got long copper back over here, copper futures, back right after the crash. Because I knew that once the economy started coming back, it was strong to begin with. So COVID just knocked it off its pedestal, but once it came back, copper was going to take off. It turned out to be a good trade. It's like 400 or 500% return in copper. And the futures was even more than that. And you can see here, it's got a little bit extended. This was my near-term target with copper here. It's hitting it, run into a little bit of resistance as we would expect, right? You can see the resistance level right here. We're coming right into it. This resistance is a combination of Fibonacci extensions and Gann. I don't like all these lines on my chart. I guess you're looking at these yellow dash lines. These are all pivot point price. This is a trend level solid green line. And this is just a combination of Gann and Fib. So I don't get too many lines on my chart. But it shows it's a great area where we expect to see resistance and or support. So this is kind of where we are right now. So we're going to probably chop around, maybe even come back to this upsloping trend line like we had over here and over here. I think it's going to rest a bit, and then it's going to make another run higher. Okay. Palladium, you can see here with palladium, let's just flip this over like this. You can see on this weekly chart how we made new all-time highs with palladium. The last all-time high was on February 2020. Then we crashed, and now we're back up again, right? And if I put it back on the daily chart, you can see how this move here, we just broke out. I think a little bit of a pullback to this prior all-time high, but notice the MACD. We're getting across, but there's no divergence. That means any pullback is going to be bought. Palladium is big, just like copper, on green energy. So solar panels, batteries, green energy stuff. Palladium and copper is a strong place to be. So that's why we've been long these guys. Just good trades, right? So that's kind of what we're looking at on these moves here. Of course, if we come in and look at energy, energy pull back a little bit. But like I've been telling our members, once we got up here, I said fade the move and then play it sideways. And that's kind of where we're running right now. So unbalanced condors, unbalanced iron condors or call condors all is a great way to trade this thing. Same thing with unbalanced flies, just a really good way to play this in the futures market. All right, so you've got a little bit of a hedge here, but you can make some nice money in this as it runs sideways. Going out 60 days, all right? Oil futures contracts expire every month, but I'd go out 2 months and make a play. You get some nice premium, and then you just ride it, right? That's kind of what I'm looking at here on that. And then, of course, we got some interesting trades in agriculture, meats. Looking at softs, members, as you guys know, I'm working our members on possible shorting activity, but not yet. We're going to wait for a symbol, or a signal, rather. Lumber has just been straight to the moon. The supply chain is messed up big time. I'm even seeing things I've never seen before where they're moving stuff in the supply chain back up the chain instead of down through the chain just because of the problems. We're coming into the summer months in most places, which is when building activity is the strongest. And it's lumber is the most expensive. It'll put a crimp on some building activity. I think it's got a little bit more ways to go, and then I think we're going to have a huge pullback. Great opportunity for making money in this. All right, everybody, that's kind of where we are now. If you're not a member, I'd highly encourage you to come in. Some of these commodity trades are just, I consider them low-hanging fruit trades, just like currencies. We jump in them and we get in, we make our money, we get out. For our members, this Sunday night, we got our weekly market watch. Everybody else, I will see you next weekend. Have a great weekend, everybody. See you guys.